Hello and welcome to another edition of the Mistake-Free Real Estate Podcast. I am your host, Marck, and today I'm super excited to have one of the economy's bright lights in real estate industry, Bruce Norris. Welcome to the show, sir.
Mark, thank you for the invitation.
Oh, it's truly my pleasure. Guys, Bruce is not just an active real estate investor and hard money lender, but he really is an educator in the space. I was talking with Bruce the other day and he said, Mark, that we're in uncharted waters, but it's better to navigate those waters with charts. And so Bruce is an economist, first and foremost, but obviously someone that pays great attention to the real estate space. So today, Bruce, really just looking to dive in. There's so many interesting things going on here in 2022. You've been in the industry for 35 years. Does this time remind you of any recent history that you've been a part of, or are we just completely in uncharted waters?
Well, the timing of it is different. And by the way, thank you for the upgrade to an economist, but I have a high school diploma and like many thousands of transactions that taught me what to do and what not to do.
Yes.
So what's interesting about right now, you have interest rates going up. There's a natural assumption in very bright people that say, of course, when interest rates go up, prices go down. And the only way you can make that statement is you just simply forgot to look at two charts simultaneously, interest rates between 74 and 80 and prices between 74 and 80. So interest rates were 7.5, got to 15. And during that journey, I'll just use California median price. Mm-hmm. California median price went from 34 grand to 102. So interest rates doubled and prices tripled. So whenever anybody tells me, of course, when interest rates go up, prices go down, well, what about that time? And then, of course, then you have to start explaining something. So that statement is completely false on its own. It doesn't mean that it can't happen, but you can also have 2009. What was 2009 about then? Because interest rates went from 6 to 4, not from 7.5 to 15, and prices got crushed by 50%. So maybe there's more important factors than interest rates.
A lot of people look at the GFC that happened in 2008, and it was a seismic, shift in real estate in general. To me, that was a lending crisis more so than anything. How did you react in 2008, and was that something that you saw coming?
Fortunately, yeah. We wrote a 400-page report called California Crash. And because the clients that I deal with are specific to California, we analyzed it very carefully and said, this is going to get completely ugly. We have studied it for a long time. That was the second major cycle report that we did. We called it an upside, and then that 8-year period happened, and it kept getting crazier. And so it went beyond where I thought was reasonable. So we have some metrics that we look at and say, okay, well, this is overdone. Why is that happening? And so at the time we interviewed a lender, because I was trying to understand, well, why are we getting to this point where it seems completely ridiculous? And in interviewing the lender in front of a crowd of hundreds of people, the first question I asked was the only one I asked. I said, stated income loans. Where does that stated income number come from? And without batting an eye, she said, oh, we just make it up. And there was a pause, about 10 seconds, as I absorbed what she just said. Every loan that we fund is fraudulent, and we could care less. And I just went, oh, okay. I said, I think that's the only question I need to ask. Thanks for coming. And that was when we said, this is going to be a big problem.
You still deal with a lot of mortgage bankers. Have we gotten back to that same level of insanity, or are we making good loans?
You're making good loans, but see, your math changed in 60 days. So I look at something called affordability as being a key tipping point. Well, we were pretty safe. I'll go to California's history. We have a history of ending at 17% if it's a legitimate lending market. That's a top price or top payment ratio, okay? 17% affordability, saying that you got there in 1980, 89, 2005, and you got there very quickly this time.
Hang on, sorry, can you back up? You lost me on the 17%. What exactly are you referring to?
17% is an affordability number. It's how they say what percentage of your population, your home owners, can get a yes answer from the lender at the current monthly payment.
Oh, okay. Percentage of the population base.
Yes,
Got
of
it.
the people that have, family units, okay,
Yep.
or singles, potential buyers. Well, 17% is a historical low that we reached in 80, 89, 06, 05, 06, and then we're probably there now. The California numbers I checked this morning still aren't out, but 1 quarter ago it was at 24, but the interest rate hikes, I'm sure, have taken it to 17.
Mm-hmm.
What that is saying is that at the current 5% interest rate, we are equaling the same impact as 15% in 1980. That's where we're at.
So are there similarities between 2007 and 2022 that concern you?
No, much more safeguards in place because, for instance, Florida got devastated because there were people that were able to buy 50 houses that lived in California, bought them in Florida, said they were going to live in each one of them, and the lender funded all the loans. And so when this foreclosure happened to a person, it sometimes happened to 50 houses. We didn't have that nonsense this time. So a lot of safeguards are in place. Fixed rate loans instead of adjustable loans, actual honesty on the application, down payments. And one of the biggest factors is leaving equity in place. So huge amount of people haven't refied. We actually learned something. Let's don't just crank everything out of our house and go buy stuff. So there's a lot of safeguards. Now, we're letting a little bit of the cat out of the bag, but that's fine. To me, the most important chart that causes price damage is the ratio of foreclosures that are allowed to be in the marketplace. So the lenders learned in 2009 that maybe it wasn't the smartest thing to foreclose on everything that wasn't making a payment. And it became the most damaging thing for the California market because in 2009, we had a ratio of all of the listings in the MLS were basically dominated by 75% REOs.
Wow.
Which meant that it dominated the appraisal world. So here's a real example. So a home that was $365,000 in Moreno Valley in the peak of the market, 2006 or 7, would get foreclosed on a lender, and they would own it for approximately a year, trying to get $295, $255, $195, $150, and they sell it for $65,000. About 20 cents on the dollar is what they were getting. Now, I'm a flipper. I buy that. I fix it up. I put it up for sale. Put it up for sale for $125,000. 25 offers first day. Appraisal, 95. Okay, and why? Well, because 75% of the evidence is saying it's worth $65,000. And so that's the damaging thing that this marketplace cannot allow to occur. And the lenders, I hope, have learned that they cannot dominate the marketplace with comps, because there was also pressure on the appraisals. Remember, back then, review appraisers probably had the biggest role because, okay, 25 buyers raised their hands and said, yeah, that's what we want. We'll pay $125,000 for it. And an appraisal comes in at 95. Well, why? Well, because if he came in at 125 and it got challenged by another appraisal, a review appraiser, and said, no, it's really 95, that other guy would never get another assignment. So the pressure was on to be conservative, and the numbers were there to justify it.
How have the institutional buyers impacted this space? Do you believe that some people are saying that there's an artificial floor effectively across, and again, I'm probably talking now to the Midwest and through the Sun Belt, but there's an artificial floor because hedge funds are here to stay. These institutional buyers, obviously have created a new asset class in the single family space, which I believe that they're committed to for the long term. Do you feel like there's a floor on the market, knowing that if there was a 5 or even an 8% dip, that they would say, hey, long term, that's a hell of a savings. Let's go buy as much of that as we can.
It's an interesting point. First of all, my son Aaron is really the expert on that, but I've seen some of the data that he looks at. So their model is a very tight range of inventory. So if you look at what they buy, it's a certain size home, it's a certain age home, it's a certain bedroom home. So there's a lot of inventory that doesn't meet their criteria.
Yep.
So you could have that maybe supported, that little section. Typically, that's not how it works. So I think, yeah, anybody that's a buyer of that inventory will be helpful. But I think what also happens is if they allow this to get dominated by lender-owned property, see, I'll just go back and say, I don't think that's going to happen this time. I just don't see the lending base in trouble. Think about the properties that are not going to come up for sale too. And this is really important. Let's say you've got in place a 2.5% or 3% loan, and the interest rates jump to 5% overnight. And you were thinking about selling, and you've got this comfy 2.5%, 3% mortgage in place. I wonder what percentage of would-be sellers are deterred to saying, you know what, I'm good. My house isn't going to go on the market, and I'm just going to stick with my cheap mortgage. I think that's going to keep a lot of inventory from going up for sale unless it's a have to thing.
So I've heard that the CEOs of these large corporations, Invitation Homes, American Homes for Rent, they come out and say, well, we only have 2% of the market. To your point about them being very specific, I think it's a bigger market share than that as far as what they're wanting to buy. They're looking at all homes in America saying that it's a 2% market share, but really, what they're going after in force. Do you believe that there will be legislation against corporations coming in and buying houses? Is that a thing that could, I know that there have been, I was down in Chattanooga recently, and the county that Chattanooga is in came out and legislated against any new permits for vacation or Airbnb type properties in the city. So basically they're outlawing any more Airbnbs to come, and you cannot transfer the license. So they're trying to actually diminish it to protect their hotel base. That's an example of a legislation. Do you think that they could do the same thing with, institutional buyers, trying to dissuade them from cornering the rental market?
Yes, and a lot of times the blame for the activity of buying and reselling a property also spills over to the individual investor. So in California, there's some proposed legislation for giving you a 25% tax penalty of your profit if you are in fact buying and selling something. And so Aaron did a fair amount of analysis on that. And these big companies are putting in an average of under 10 grand a house to flip it. And people in our industry are putting an average of, say, 15% or more into the improvements. And so it's a very big difference on what the entrepreneur, the single company that does it for a living, the product he's giving the public is a much improved product that is going to sell for more, and it doesn't need to be fixed. So I certainly don't like the government in getting involved in that type of thing, because they're usually doing it incorrectly. It's very popular to do something, but I think they could leave the entrepreneurs alone. That would be better.
So what mistakes are out there that investors need to avoid? Do you still feel that that the space has legs, has growth? Where do you see the next 24 months? A lot of our listening audience, Bruce, are those that are looking to, use real estate as a long-term play, a hedge against inflation, perhaps a wealth strategy for their families. Is that still a viable option? Is that still the smart play? And where should they be looking as far as looking at things that would be triggering them to say, hey, maybe I need to take pause and look at a certain market differently?
Well, what's really interesting is there was a study done by Cal Poly Pomona, and that's in California, as a college, and they had a report that they produced from the 60s on, so it's been around for 60 years. And one section of years, they actually, during the inflationary cycle, they broke down the construction cost of the house. Every year, same house, which was really an eye-opener. They also calculated the labor cost. So what's really interesting about when you own rental real estate is you own a basket of commodities. Because as Lennar's walls go up, as Lennar's concrete bid goes up, gosh, you own a commodity that just went up too. And that's really true because there is a price correlation that's direct to existing and new homes. You'll never get the spread to be ridiculous. There's always, as a matter of fact, in California specifically, and that's where I'm obviously most familiar with statistics, 3 times in history, the existing home price is more expensive per square foot than the new build. My walls are more expensive than Lennar's, even though they've existed for years and years. So to answer your question, real estate's an inflation hedge because of the commodities it takes to build it, including labor. So labor for a plumber went up from, say, $7.50 to $15. And lumber went up and all that went up. Well, if you had a rental in the beginning of the 70s, you had a big smile on your face because your house mimicked that market price. There wasn't just the price of a new home that went up. It was the price of every structure that went up. So if you're thinking we're having an inflationary cycle that's coming, there's not going to be a gap of a new home that's worth $800,000 and an existing home that's worth $400,000. That isn't the way it plays out.
How have supply chain issues impacted new build in California specifically?
Well, I'm going to go specific to Florida because we're building so many homes there right now. So it's manageable, especially if you're on top of it. So I'm going to start a new home. I think, well, I'm in permit stage, but I guess I ought to order my trusses. And so literally you're ordering things 5-6 months out that you'll need, windows and all that. If you don't do that, yeah, you'll be a mess. You'll have some big problems. So gradually you get used to, okay, I have to have this all stacked in advance. And so it's doable. It takes a little longer to build. And some of the delays are also coming by the city. The city has a problem with manpower. Just there's a lot going on. And so they're taking longer and longer for inspecting things.
Builders seem to be making record profits and not over leveraging themselves either. They seem to be in a really strong position. That gives me comfort. I feel like one of the massive industries that got impacted through 2008, 9, 10, 11 was just new home construction ground to a halt. And there was so many foreclosures, even on land and future land that was owned by builders. Don't think we're in that same position now, are we?
No, but see, that's one of the points that I think about. I'm always thinking about buying what everyone else doesn't want, to be quite honest with you. So I want to buy land in that scenario that you just said. We were interviewing Doug Duncan, chief economist of Fannie Mae, and to prepare for that, this was the first quarter of 2015. And so to prepare for the interview, I read the fourth quarter for Fannie Mae's financials for 2014. Mm-hmm. It said that 25% of Fannie Mae's losses come from one state, Florida. And I thought, well, how could that be? Because California is already doing well. Why isn't Florida? Well, they had a 4-year foreclosure process. And I went, they're in 2011. I got a big smile on my face because I know exactly what to do with that. So one of my best friends lives in Florida. I said, poke around and let's buy tracts of lots that can't be built on because everybody's selling houses below replacement cost. And so that's what we did. And so that's where my rentals are on those lots. So I think contrarian. And so now we've been building houses, and to say that profit is high it's scary high.
Yeah. Things
that you thought you were going to get 654 2 months ago would go for 950 with 10 bidders, all cash. So it's really interesting right now. Okay, so now we have houses coming out. and the activity level is still alive, and we're getting showings and all that. So just carefully monitoring what the mood is of the buyer, because 2 months ago it was euphoria, and now that euphoria is backed off. And a lot of the buyers are cash. That has nothing to do with financing. It's just that the competitor maybe there was 1 or 2 finance buyers in with 12 offers. The cash buyer had to compete with the finance offer to beat it. And that's slowing down. So you're probably through euphoria, but so what's next? Have we overbuilt? In most areas, probably not true. And especially in California, when you're in a peak market, California, generally 150, 160,000 new construction homes. 1980, 89, 2005 and 6, 2021, 55,000. And it's been that way for the decade. So California is just unusual. It's very hard to get approval of a tract, and they're just way behind. So a housing shortage does exist in California. The problem is, the last time I checked, the median price was something like $890,000.
Yeah.
If you match that with a 5% interest rate, your migration goes through the roof.
Which is what we're seeing. I mean, Meredith Whitney's book, Fate of the States, was an interesting read. I think it was written back in 2013, but certainly she predicted a lot of what was going on, and different topic. But I mean, effectively, we're seeing mass migration, really. I mean, is it a net 300,000 loss each year for California at the moment?
I would say at least that, because for the first time they actually lost real population, which means the birth rate didn't exceed death and exiting. So the only way California gets any population now, 100% of its population growth, if it exists, is births over deaths. So that means no new adults are showing up to buy California real estate. It's fortunately they have a housing shortage, so they actually will probably be supportive of a price. But where I want to have my money is where people are coming from more expensive areas, and that's Florida. So people from Canada, New York, New Jersey, Chicago, they come to Florida and think, wow, this is cheap.
And we're seeing that in Midwest too. The affordability crisis, I think, is a very real thing. I know that people are talking about there's still a housing shortage, but what's your take on the affordability? I mean, there's got to be a point where, in your example, a 650 home that's now going for 900, it seems unsustainable.
Yeah, I think it probably is. But let's unpack that affordability crisis, because it's very interesting what happens to every other chart as affordability goes down. So an affordability crisis. Okay, California Association of Realtors has this to say about affordability. Affordability is equal to real estate well-being. So the peak of well-being for California, if that's the formula, was in 2009, as affordability went up to 56%. Your prices crashed by 60%, and somehow that magically was was wonderful. Mm-hmm. The height of well-being. Well, what happens is exactly the opposite. When affordability declines, you build more houses, you sell more houses, even though the math sort of says, well, that shouldn't happen. It happens every time. And so as affordability goes down, what that means is that there's a math function. Well, how do you end up with an affordability number? Well, and how does it go down? Well, prices go up, for one. And going up supports, hey, you know what? Maybe I should get more of these. And so that starts to feed. You buy your first house and go, wow, look at that. I got $100,000 of equity I've never had. Maybe I'll take another. So affordability going down facilitates more construction, more sales, lower and lower inventory every time until it hits a point.
And I feel that's where we're at.
Yeah, you're right. No, but mathematically, you don't have to guess about it. You're there. So the next 2 years, and again, when I'm speaking in front of your group, it's really important they understand that this has happened. This is the 4th time this will have happened in my lifetime. The other 3 times it happened, you had very different outcomes. Very different outcomes, even though these charts are going to get negative. Your sales are going to go down. Your inventory is going to go up. Your foreclosures are going to go up. All of those things are going to get turned negative. Construction will go down. Those are all going to turn negative. Does it have to damage price? The answer is one out of those three, it did not. One of the three had mild, and the other one had devastation. And so that's what we'll talk about that day, is so you can see this is what you look out for. If you think prices are going to get devastated in the past, this is the element you have to have.
What Bruce is referencing is our affiliation with Collective Genius Mastermind Group. Super excited to have Bruce as our keynote speaker coming up in Tampa, Florida. So appreciate you joining us in that event, Bruce. It's going to be great for your insight into this space to go really, really deep in a keynote presentation. We're really excited and appreciate you coming.
Thank you.
Investment homes and rental real estate. How is this affordability also impacting rental rates? What I saw in 2008 in the foreclosure crisis was almost a strengthening in them throughout the Midwest of rental rates. At least it didn't go down. You suddenly saw this massive demand of clearly people needed a roof over their heads. They've just been foreclosed on. It certainly changed the way that we screened our tenants, and we're looking at people that had an atom bomb go off on their credit report, but you kind of threw that out the window, knowing that, hey, this guy's still making $150,000 a year. I think he can afford this $1,200 a month house. How does your analysis pertain to rental real estate and the affordability of said real estate?
Well, what's really interesting is the rental rate increases that we've experienced the last couple of years. So I did just yesterday, I sort of played with this because we have a property that's going up for sale, and it went up for sale a week ago and it already sold for $700,000. The previous one sold for $650,000.
Is this new construction?
New construction,
okay.
But so we got more money than we had gotten for the same house before. When we started building it, we thought it was $515,000, by the way. So one just went pending for $700,000. And I started thinking, okay, what does that rent for now? Well, it rents for $2,600. How does that compare to a PITI payment at 5%? And it's within about 10%. You have a $2,900 PITI payment and a $2,600 rent. I would make that decision. That's still within the range of, okay, I'm going to rent this for 26 or buy it for 29. I'd land on the buying side of that. So that's at 5%. So I think I would look at that and say the rents have risen so much that they're going to be very supportive of the current level of pricing and then this interest rate. If you go from here to get 6 or 7% mortgage rates, that'll be a math equation. So that won't be, okay, rushing to create foreclosures, but it's going to be a math problem that says, okay, less people really do qualify, and you're not going to sell the properties. One of the things that, and we were asked to go to Fannie Mae in Washington, D.C. and have lunch with the CEO. So it was a one-on-one lunch. We talked for about an hour and a half. And one of the things that I suggested to him, and I don't know how this is possible, but it would be smart, is to let the current interest rates loans that are in place move forward to another buyer. That would save the market.
Assumable mortgages.
Yeah, and you know what? They also should have done something else, and this was suggested at the downturn. So in 2009, 2010, we have this annual nonprofit. We have a charity event.
I Survived Real Estate. Mm-hmm. Yeah, looking forward to sponsoring that event this year.
Very happy you guys are doing that. Well, in the intro, I suggested to Fannie Mae, because I could see Wall Street coming and buying all these homes. I said, okay, because we were offered $1 billion to represent them doing so. We had invited to a dinner with the 10 largest hedge funds. I was like the keynote, only it was a dinner table with 10 of them. And, we left being offered $1 billion to invest, and I didn't want to do that. So when we had the meeting, I said to the people there, we have a charity event. Those are some of the top people in each of the industries, the Mortgage Bankers Association, Chief Economist, Fannie Mae, and on and on. I said, you know what we really need to create is we need to create a nothing down loan that qualifies like a VA. And you have one foreclosure in our law, not 50. You literally just say, okay, if you don't make your payments in 6 months, we open up the bid, and the bid is nothing to do with the principal. It has to do with the back payments. So know what? You're not going to have an REO show up out of the whole bunch. The opening bid is going to be 6 months of whatever it is. Right now, the payment will be less than rent, and you'll change the lives of millions of people that will never get a shot at owning something and not have one foreclosure. Because the interest rates maybe at the time were 4 or 5.
Yeah.
And the prices were, down by 50%. But sometimes what happens, we also were invited to Washington, D.C. to speak in front of a group of higher ups, talk about that concept. Some things that are practical sense takes forever to get accomplished. It doesn't happen. So you can have some really good ideas, but unless you can pull the trigger and you can get it past the eyeballs that are trying to please all the people in the public.
Yeah.
Because, the concern is, nothing down, here we go again, we'll be in foreclosure. Well, no, you're not creating an REO. You're going to create home ownership that goes up another 5 or 10% and change all those people's lives. Can you imagine how many people would have equity if that had been done in 2009? That would have been crazy.
Absolutely. The other thing I think would have avoided a massive, as interest rates go up, one of my thoughts, I don't know, I'm sure it's just the bankers wanting to get paid on a new loan, but why can you not transport your existing mortgage to the house that you're choosing to buy? If we're locked in at 2.5% on a 30-year fixed, I've gone through the prepayment, I've gone through all the qualifications. Clearly, there'll need to be appraisal issues and validation of a little bit more money down or whatever, but why can you not take that mortgage and just continue and take it on to the next house?
That would be a very smart choice. But so what's going to happen if you don't do that? Let's say you have interest rates that get to 6 or 7%. You're going to have two sets of values. So you've got a $900,000 mortgage that's at 2.5, and if you put it up for sale, the new mortgage is 7. Well, that's going to probably be a different price, and so that's why you'll keep it. That's going to put a lot of people out of work. Your real estate volume will go down a lot. Because there'll be people that say, I'm just going to stay with my mortgage. Yeah. So that inventory is not going to show up.
I think I've heard you talking before, Bruce, about I'm going to say homestead home. Like there's a percentage of boomers that are coming through now that it used to be downsizing, and downsizing was becoming or is apparently becoming less and less appealing. And a lot of the boomers are coming through and saying, you know what, I'm just going to keep the house. It's paid off, or I've got a 2% mortgage on it and I only owe $100,000 on a $900,000 home. My payment's next to nothing. I'm not going to downsize and go buy something for $900 that's much smaller. Is that something that you have looked into? Is this a trend I can't remember where I heard it. I'm crediting you. I'm not sure if that's accurate or not, but I've heard that there is this trend of people willing to keep their large colonial, bigger homes rather than selling and downsizing. Have you seen this?
That statement didn't come from me. And I think I have, it's interesting. I think that people can facilitate like their next life by selling that home. So I guess I would fall onto I would look at the math equation and say, how many times in your life can you get a $500,000 check from without having to pay any tax?
Yeah.
A lot of times these people that are selling homes have these huge gains and they're completely not taxable. And, you run to Florida with a $500,000 net check from a sale, you're going to end up with a home that's much different than probably the one you sold in California. That's for sure.
Fair.
So I do think people are choosing not to live in a small home. I think that's true. I think people are maybe not always downsizing. They're saying, I like space,
So look, I think we've got to the point where we can clearly, we've talked about us being at a precipice, if you will, or at least a pivot point. What will be the triggers in your mind that put us over the edge? What are the things that could happen that we should be paying attention to, and where will it happen first? Should I be paying attention to California and Texas and New York, or where do you think a downturn or a potential recession hits first and hits hardest?
That's really an interesting question. I don't know that you have a big difference, but let's go to California. So California is probably at that affordability breaking point. And I think this is going to be mimicked all over. Sales are going to slow. Inventory is going to grow. Building is going to go down. And foreclosures are going to increase. So the big four charts, those are all going to happen. So let's talk about foreclosures increasing. So right now, how many foreclosures are there compared to the past? I'll just give you, let's say in California in 1980, there were 400,000 sales. We got to about 100,000 trustee sales. It represented about 25% of the market. In 1990, let's just use 400,000 sales again, we got to about 150,000 trustee sales. And if we had 400,000 sales in 2009, we got to 300 trustee sales. So the answer to what's next is that ratio. Because at 25% sales to trustee sales, it doesn't dictate what the appraiser has to come up with. A very rational appraiser can say, you know what, that one comp of 4 is not going to dictate the price. When you get to a third or 40% of the market, the appraiser has to look at it a little bit and give it some weight. When it's 7 out of 10, it is the comp. So the answer to your question is, keep your eye on foreclosure ratio, but don't get excited about percentages. Because how many foreclosures have been in the marketplace in the last 5 years? Declining into almost nothing.
Yep.
So you could easily have somebody say legitimately, wow, trustee sales are up 3,000%, and it'd be a completely meaningless statistic, completely.
But percentage of foreclosure sales compared to overall sales is the statistic that you should be paying attention to.
That's right.
Yeah,
that is exactly right.
Man, I didn't realize how appraisals and foreclosures are so intermingled.
Oh, absolutely. Because I mean, we on the panel that year was the president of the Appraisal Institute, a gentleman named Mags Ziaris, and that interview could be listened to, because that was important as a flipper. As you can imagine, here we are flipping properties and putting in, here it's great. And it's a great house, and it's for sale for $125,000, and it used to be for sale almost 3 times that, and we can't get an appraisal for over 100. It was ridiculous.
Well, Bruce, they say all good things must come to an end. This has been a fantastic session, and I really appreciate it. I'm looking forward to going even deeper with your keynote presentation at the Collective Genius Mastermind coming up here in Tampa in just a few weeks. So looking forward to that. How can my listeners or people follow you? Do you is there a radio show? Are you active on Instagram or any of the social media networks?
Joey at thenorrisgroup.com would be the email to ask any of those questions, because we have a website, a lot of free education, and many, many years of radio interviews going all the way back to probably 15 years or so.
Well, we'll make sure we'll put some links below, because I know they'll love to keep up with you and all that's going on in the market. Thanks once again, Bruce. Really appreciate your time today. And for all those listeners out there, hope you enjoyed this as much as I did. Take care.
Thank you, Mark.
You're listening to Mistake-Free Real Estate Radio, the authority in passive real estate investing. No late-night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.